This week's lesson is about a particular financial institution that sits at the heart of the global payment system, ultimately enabling us to engage in even greater specialization and low cost ledger based transactions between far flung regions. And those are central banks. Central banks are designed to help facilitate the flow of capital between organizations. Broadly speaking, the concept is fairly straightforward. Just like a bank creates a payment system which intermediates between borrowing and lending individuals, a central bank creates a payment system that intermediates between borrowing and lending banks. Now, today, most central banks are well controlled by their sovereigns, which means that central banks are under the control of their respective governments. But this has not always been the case. In fact, for the first couple of centuries of the central banking as we know it in the modern world, these organizations were entirely private and were simply serving the government as their client, as opposed to being under its control and direction. But it's worth noting, of course, that central banking doesn't actually even require the existence of a government. For instance, in 1872, Friedrich Wilhelm Raiffeisen helped to create what was called the Credit Union Central, which was effectively an organization that would allow small regional credit unions to supply each other with emergency liquidity in the event that there was a problem in one particular region. Hopefully remember from our last talk on banking that credit unions were established to try to help farmers escape from the tyranny of loan sharks while they weren't otherwise being served by the banking sector themselves. While this idea took root very, very quickly, one of the inherent problems with it was that everybody within a valley or a community that lends to each other will be struck down by the same kind of systematic risks. For example, a drought that affects the entire valley. And therefore, it might be important to have connections between other regions such that farmers who are in a prosperous region can help to support those who are facing particularly challenging situations. But before we move on to talking about how governments play a role in central banking in the modern world, I want to start off by looking at a couple of examples of what having a banking network enables, which is in general a wider payments network that leads ultimately to a currency monopoly. This can also lead to possibility of an interbank loan market, which substantially improves stability. So the first of these that I'd like to discuss with you actually starts off in the early modern period, um, in the late Renaissance. So the story in this case starts off in France, where we used to see significant fairs in the old medieval fair system, dating back as far as roughly 900, maybe even 1000 AD. These large fairs effectively served as clearinghouses for large retail and wholesale traders in goods that were being transported far distances. You would have things like wool or cloth coming from Northern Europe and spices and dyes coming from Southern Europe, which had ultimately imported it from India, China, and the Middle East. And these fairs effectively served as a clearing space, originally for retail transactions to take place and for merchants to buy goods from each other. But as the centuries progressed, these merchants began to adapt rather, this fair system away from purely retail trade towards clearing wholesale trade, and eventually towards clearing financial payments between merchants. And it's this financial layer that came to be ultimately the most important aspect of these medieval fairs. Now, a particular breakpoint occurs in the medieval fair system in 1575. There has been a significant fallout at this point between an organization called the Bank of St. George from Genoa and the Spanish Empire. Now, when this sort of problem occurs, the Genoese decide that it's no longer safe for them to operate these sorts of large fairs in territories that are easily seized or controlled by the Spanish. And as a result, what they did is they moved the location of the meetings and moved the locations of the fairs out of France to a more secure location. One of these was in northern Italy. In general, what we saw at these fairs for a span of about 40 years was that the most important bankers of Europe would gather together every 90 days at an Italian town called Piacenza, and they would net out the interbank payments between them. At the same time, they would also establish what the exchange rates for Europe's currencies were going to be for the next 90 days, not necessarily by the decree of some king, but simply based on the essaying of metallic currencies that were in circulation at the time. Now, the most powerful of these banking groups were the Genoese. They had the final say in any sort of dispute between the other bankers, but ultimately they managed to sow the seeds of their own defeat by trying to move the physical location where this intersystem settlement took place into their own territory. Rather than meeting at a what was considered neutral ground between the bankers of Florence, Venice, Genoa, and Milan, they instead tried to move it into Genoese territory, which of course was not well taken by the others, who systematically abandoned the notion of a fair system. And we see the demise of this kind of intersettlement system occurring around the 1620s. Moving forward a few centuries, there's an interesting example of how a network of banks can protect itself against systematic problems, which is to say, a bank failure that could cascade throughout the entire network. The particular story I have in mind takes place in 1907. In 1907, there was a significant liquidity crunch in New York City. There had been some copper traders who lost an extraordinary amount of money. They were unable to pay their loans to their brokers. Their broker failed, and as a result, their bank failed. When one bank failed, it very quickly cascaded into a series of bank failures that ripped through the entire financial sector in New York. At the time, there was no central bank in the United States. There was no lender of last resort, and the state of New York itself found that it was paralyzed in trying to respond to the crisis because it too needed to roll over substantial amounts of its own debt. And in the absence of freely available capital in the banking sector to do this, they themselves faced the possibility of bankruptcy. So, in order to try to calm the panic, a number of the city's major financiers tried to step into the gap. And the problem was that every time they seemed to solve one part of the problem, it escaped out from under them into another institution. And it took several attempts to ultimately halt the bank runs that were threatened to paralyze the city and collapse the entire financial system of the United States. Now, the way that this crisis was resolved was through the intercession of the city's top banker, John Pierpont Morgan, or JP Morgan, that you can see here at the top of the slide. JP Morgan is often much more famous for assembling such large-scale trusts that were ultimately broken up as US Steel, but it's important to recognize that he was also essential in saving the entire banking system of New York and potentially the United States back in 1907. In one particularly jarring instance, he invited all of the presidents of the city's top banks and trusts to a meeting at the Morgan Library, where he proceeded to lock them in the library and told them not to bother trying to escape, that the police were already waiting outside to prevent them from escaping. And even though they had been largely taken aback by this effective kidnapping, it did nonetheless drive them to cut a deal finally around 3, 4 o'clock in the morning, whereby the top bankers in the city would step into this gap, both with the wealth of their own organizations, as well as their personal wealth. Now, this managed to stop the bank runs ultimately because they were able to pump enough cash in the short term to stem the massive tide of withdrawals that had been threatening the entire system, and to help signal that most institutions were in fact stable and solvent at the time. Now, nonetheless, despite the fact that Morgan had been able to save the financial industry arguably from itself in 1907, a number of his competitors were quite worried that they would not necessarily be able to count on old man Morgan to save them during the next crisis, particularly since many of them were his competitors. And even though he had managed to corral everybody into working together to save the financial ecosystem upon which they all relied, there was concern that the idea of bailing out institutions would not necessarily have been proceeded with in an impartial manner. And so many of the bankers in New York petitioned the central government in the US, the federal government, to create a central bank that would act as an impartial lender of last resort, rather than leaving themselves in a position of hoping JP Morgan would arrange a bailout for them should they run into difficulties once again.